Hey, my name is James Nicholson and welcome to my YouTube channel. There's never been a better time to discuss tracker rates. Clearly, interest rates are moving down. We've been making a ton of videos of banks dropping their rates. We also know the Bank of England has cut rates and indicated that they're going to cut even more by the end of the year. The economy doesn't look very great, and ultimately what happens if we go into a recession is rates invariably go down. Well, in this video, I'm going to talk about what's the breakdown of who's on tracker rates, who's on standard variable rates, who's on fixed rates at the moment. We've got all of that data in here. We're also going to talk about the expectations on where is the Bank of England going to end up and what that means for you making a decision to get a tracker rate or not. Well, if you're new around here and you haven't done already, do make sure you subscribe to my channel over there and hit that bell notification. We're on the way to 42,000 subscribers now. We're not that far away from it. And let's get some more views on this video. How do you do that, you ask? Simple. Smash like, tickle like, do something to that like button. That massively helps with the YouTube algorithm and really helps the channel grow. So thanks to everyone that does that. So the Bank of England's cut rates 4 times now since last August, which is good. We're moving in the right direction. But there's news this week coming out of the Bank of England that they might slow those cuts down. Even so, a lot of analysts think that the bank will cut 3 more times before the end of 2025. In fact, Barclays think that they're going to cut 3 more times by September, which would make a massive difference to everybody that's on a tracker rate. Now, I recall when we started this channel, it was 3 years ago now in March of 2022. At that point, rates were going up. And there were lots of people in the comments saying, look, I'm going to take a tracker rate. And if they did, it probably wouldn't have worked out very well for them. We had inflation that was rising, rates were rising, and ultimately, if you were on a tracker then, your payments got progressively more expensive. But now we're on the back end. Look, inflation could come back. The Bank of England has said that themselves. In fact, they believe that inflation will be higher by the end of this year. Their forecast initially said 3.7%. It's gone down to 3.5%. So it's moving in the right direction, but it's still stubborn. But they've also said that's not their key focus anymore. Inflation is important and one of the metrics that they're looking at, but now they're also looking at unemployment, and that has been creeping up steadily. You've had Labour who have increased national insurance, increased business rates, and caused lots of pain for small businesses that ultimately could mean that they're forced to lay off staff. And if that happens, that means unemployment's going to rise, and that means we could have a recession, and the Bank of England would be forced to cut rates a lot faster. Now, what is a tracker rate? If you don't know, I'm sure you do, but if you don't, let's quickly give you an overview on what a tracker rate is. A tracker rate is a rate that follows very closely to the Bank of England base rate. And what is that right now? Well, today, the Bank of England base rate sits at 4.25%. Now, what normally happens is they put a bit on top of that. So the part that they put on top is about 0.5%, meaning tracker rates roughly at the moment, depending on lender, are around 4.75%. Now, that's higher than some of the rates that you can get. You can get rates at 3.99%, 3.75%. There are rates that are cheaper than that. But the benefits of the tracker are that you don't get any penalties if you want to leave that mortgage. So let's just say rates plummet and you want to get a 2% rate that suddenly comes available and you want to fix that rate and lock it in. Well, you can normally leave, you have to check the terms, but most tracker rates will allow you to leave that mortgage and go to that new lender, which is very, very attractive to a lot of people. Now, also, a lot of people have the belief that rates are going to drop significantly because the economy doesn't look great and inflation hopefully it's coming back a little bit, but not going to be going up to the 9-10% that it was. And so a lot of people are gambling on the fact that they feel rates are going down. Also, economists are saying that as well. And so a tracker rate allows you, as the rate goes down, so if it goes down to 4%, your rate would drop to 4.5%. If it goes to 3.5%, your rate would go to 4%. You're always just going to be that 0.5 percentage higher than the bank rate. So that is attractive to a lot of people. Now, let's just give you a breakdown on what the market is at the moment. Currently, there are 7.1 million people fixed on a fixed rate, which is the majority of the market. Most people are on a fixed rate. How many of those fixed rates end in 2025? A lot. 1.6 million people are going to have to change their rate in 2025. That's a lot. And for some of those people, the new rate could be quite a shock to them, because I've got some rates that are at 1.5%. I've seen you guys comment saying you've got rates at 1.2 and those kind of things. They were the absolutely incredible rates that you could get back when interest rates dropped considerably. So these people are going to come out and sit on these higher rates compared to what they've had. And so they may want to get a tracker in order to have the opportunity for the rate to go down and not be stuck on this higher rate for a long period of time. What else is going on? There are 591,000 people that are already on trackers. They're sitting there benefiting from this kind of rate, 4.75%. So they are benefiting from that. And each time, like last week when the rates went down, that works well for them. How many people are sitting on the variable rate? This means that they are sitting on a rate that is the standard variable rate for the lender. There's 540,000 people that are on that variable rate. Now, that could be for a few reasons. Maybe they finished their old deal and their circumstances have changed. Suddenly, they're not eligible to remortgage with that lender because their credit rating's dropped, or they can't move lender because of that, or their house value's gone down and they're stuck on that standard variable rate. That's a little bit more scary. A standard variable rate is very different to a tracker. Some of them with lenders, I've seen them, are 5% above base rate. So you're looking at 9.25% in that case, which isn't very, very good. What are the expectations on rates? Because this is a consideration on trackers, right? So currently we're at 4.25. There's a lot of consensus that by the end of 2025, we will be at 3.5%. That means your tracker rate would go down to 4% in that scenario. I don't think that it's going to drop much below that this year. We have a limited amount of Bank of England meetings, and we would have to have a recession or very bad unemployment data for that to happen any faster than that. Meaning, if you want to get to 2.5% or 3%, something drastic would have to happen. So I don't see that going down. But that's still attractive to a lot of people to get to that 4% rate, because maybe they're not eligible for the 4% deals that we talk about on this channel. Often we talk about 3.99, 3.75% rates, but you've got to have 40% equity. On a tracker mortgage, that's not the same. And it also gives you the benefit, as I said, as the rates come down and you think now's the time that I want to lock this in, you don't have that penalty. And another consideration is maybe you get bonuses from work, or your personal circumstances are doing quite well. Often with a tracker, you have to check this with your broker, but most trackers, you can overpay more than 10% a year, which allows you to reduce your balance and reduce your monthly payments and save on interest as well. So look, it is a time to consider trackers. It's not for everyone. You have to look at the worst case scenario in this. Tracker rates can also go up. Let's just say inflation came back at 6%, 7%, 8%, and interest rates had to go back up. Then your tracker rate's also going to go up. So you have to go into this knowing what is likely to happen on both ends of this. But I do think it's time to consider this, and it is something that you should look at and talk to your broker about if you're looking at a new deal. Do let me know in the comments what you would do. Do you like a fixed deal or do you like a tracker deal? Personally, I fix my deals. I like to know where I'm at and what my monthly payments are. And I did go on tracker or standard variable rate in 2009, 10, 11 because the rates were so low at that point, I couldn't get a better deal going somewhere else. So I sat on that for years at those lower rates. Anyway, let me know what you would do in the comments below. Do smash like, do share this video with someone that needs a mortgage at the moment. And do check out all the other content as well on the channel, including this video right here.